Hey, it's Soleil, and this is episode 165 of the Orange Pill Investor. And today I want to talk about Tesla. So naturally, I start with the graph or MicroStrategy. And just because I'm an asshole, no matter whether MicroStrategy is down or up, I just zoom out until the chart is green and has spectacular returns. So uh, I'm an asshole. But today I want to address people that are still calling Tesla just a car company. And if Tesla is just a car company and they have an unassailable lead in artificial intelligence with just cameras and sensors on millions of cars, they already have the most data and their lead is growing every single day. No one can catch up to Tesla on how much data they're compiling. And whoever owns the most data is going to win the race for full self-driving. Um, but not only that, they make their own chips when they couldn't get enough compute chips from Nvidia. So I don't know how many other car companies are doing that. I don't know how many other car companies are building a fleet of robotaxis. How many other car companies have built their own robots that work in their factories? I think it's BMW and it might be Mercedes. They have some robots working in their factories, and some others may have as well. But last time I checked, they partnered with robotics companies. So if Tesla is just a car company and they do all of these things, like solar energy and battery storage and AI and robots, but they're just a car company, then they're the only car company. No other car company exists on the planet because if what Tesla is the definition of a car company, then no other car company meets that definition. And it's fun to talk about them right now because they're up. And unfortunately, the critics that say that I'm picking up pennies in front of a steamroller kind of have a point this week. So when I went on vacation, I only put these out for 2 weeks. Some of my other contracts, I went out 45 days, and that would have worked out much better. But, and actually, let me just have a little side conversation about that. The beauty of selling covered calls and puts is usually I roll these every Friday, but I was on vacation, so I didn't feel like it. So last Friday, or excuse me, the Friday before, I just extend them 2 weeks or 45 days. Boom. Theta is draining out of every one of these contracts, and I'm making money while I'm on the beach and while I'm laughing my ass off at comedy clubs in LA, treating my dad to a vacation. I, you know, I used to have to scrape up money just to afford to take myself on a vacation. And because of the money that I make selling premium on options, I was finally able to take my dad on a vacation and basically treat him. And the only thing he really bought was food, and that was just really to make him feel like he contributed something. I didn't even need that. But so selling options has taken me from a place where I probably thought I would never retire to a place where I could pretty much quit my job. I'd have to get a little bit more aggressive on the premium. Usually I under promise and over so I can over deliver, and I talk about collecting 1% a week. But if you sell at the money puts every week, you can get 3 or 4% returns every week. And I usually don't talk about that because it's uh it's really not necessary. And it's not that is even taking a risk, because if I sell a put on HUT at, you know, $15 this week and it drops to 12 next week, it just kind of doesn't matter. I can just sell the 13.5 strike, or I can sell the 15 strike and go out to 45 days, 60 days, whatever. But they were right this week. So I only went out 2 weeks on Tesla. And what was Tesla? So today is the 2nd. So I went on vacation on June 22nd. Yeah, 22nd through the 29th. So on Friday, Tesla was like 185. So I sold the 200 strikes. And of course, while I was away, Tesla decided to blow up. And so I'm only going to profit up to these 200 strike calls on 4 covered calls. So if I don't want these to get called away, I will have to pay $3,000 a pop. I only got paid $100. So the critics have a point this week. However, here's my poor man's covered calls. Same thing. I went to the 205 strikes on these because the collateral on these were like worth, I think, like 4 or 5 grand maybe. So I only got like I got about 2% ROI on those. Now, these have gone up about 3 grand in price each. So it kind of balances these out. I will probably just go ahead and close both of these at the same time and just get rid of these poor man's covered calls. But then the other thing that I have, I started doing it in Tesla. It's a hell of a lot more affordable than MicroStrategy. But as MicroStrategy has been kind of down in the dumps, I've been buying these cheaper leaps, and I can just barely afford these ones that are like 190 something days. A lot of times people don't even call them leaps until they're a year out. So maybe some people wouldn't even call these leaps. It's fine. But I grabbed 2 more of these bad boys for 7,500 and kind of dollar cost averaging these down, because I paid for the first 2, I think I paid like 12. Might have been 15 for these. So these have actually dropped half in price. So I've been trying to dollar cost average these guys. But Tesla is a hell of a lot more affordable. And so I was buying these, and my trade price is right here. So I paid 1,100, and I think I had 7 or 8 of these. So pretty much a little more than doubled my money on these Tesla leaps. So I sold a couple. So a couple or just one? Yeah, I sold one for 1,900 and I sold another for 2,500. So that's what, 3,400? 17, basically average 1,700. Is that right? No, 2,300. So double my money on those. And to pay to roll these, it's going to cost me about 12 grand. So I may sell a few more of these to pay for it, as well as close these 2. So I can profit about 6, maybe 5 grand on each of these 2. And of course, I'll have to on each. So that's 10 grand, but I'll have to pay 5 to close these. So net profit on these will be about 5,000. I don't really want my Tesla shares to get called away. I'd like to hold these for at least a year so I can have long-term capital gains. But and the other thing is, I'm not a tax advisor. It's not financial advice. It's not tax advice. But the way that I understand it is, since I sold these covered calls for $172, and I'm gonna have to pay $3,000, this is actually going to be marked down for me as a loss. So I will actually be able to, if I'm going to pay to roll these so that I don't lose my shares, that I'm marking that down as a $12,000 loss against my profits this year. So I'm really kind of not even mad at it. It really kind of just doesn't matter to me. The only thing that really matters when I'm deciding what to do here is my idea, is what I think about Tesla still true? And if I think it's still going to be going up and the premiums we're selling, then I'm just going to keep selling it. So I can let these get called away, and then I can sell some more puts. I can do the wheel, or I can just do half of the wheel and just keep selling covered calls against this. And every time it goes over my strikes, if I just pay to roll, then and just hold on to my shares, that's also fine. I was also pretty pissed at myself because I owned several leaps on Tesla, and I was selling covered calls against them. And then when the shareholder vote came around, I had bought these 400 shares and I wanted to vote my shares, but I bought them after the deadline. So I was pretty pissed about that. But I'm glad Elon got a vote of confidence and he got the money awarded to him that he rightfully earned. But even though this is probably, I don't know, this is 10, 20% of my portfolio, it pales in comparison to the MicroStrategy holdings that I have. I kind of look at Tesla and MicroStrategy almost like a weird pairs trade. They're uncorrelated in that MicroStrategy is business development software and is not quite a pure Bitcoin play, but they're leveraged Bitcoin, so kind of is. And then Tesla, while they own some Bitcoin, doesn't really move with Bitcoin's price because nobody gives a shit about the amount of Bitcoin they hold. They only care about how many cars they sell, if how many people they're licensing supercharge, the charging network to, how many batteries they're selling, how many solar panels they're selling, how it's how many companies that they're going to sell full self-driving to, how many robots are working in the factories. That's what Tesla's valuation is. And I know us Bitcoin maximalists talk about there's no second best, but if I had to go ahead and say, okay, well, what really is the second best? For me, it's Tesla right now. And my master plan is for to sit on my MicroStrategy shares until end of 2025, and assuming that the 4-year Bitcoin bull bear cycles continue, end of 2025 would probably signal the end of that bull market. So I'll sell off a bunch of MicroStrategy, or else instead of being very conservative with my with my covered calls, I sold covered calls at 2000, the 2000 strike, when MicroStrategy was at like 1400 or something stupid. And that's still kind of dangerous because in the 2 weeks that I went out to 45 days, didn't I? Yeah. So, but in the 2 weeks while I was not trading, while I was on vacation, I mean, this could have went to 2,500 or 3,000 or 4,000. This is just whatever Bitcoin does, MicroStrategy is going to go insane. But in 2025, I will be either peeling off some of these shares, or I will just be extremely aggressive on the covered calls. I mean, I can just sell them. This is already 2 trading days out, but instead of building in like 20% call away value, which I usually like to do, I could just be real aggressive and sell a few strikes above at the money, give a little bit of growth just in case, but just being real aggressive and just buying, or selling a shitload of premium. And then if MicroStrategy and Bitcoin are at all-time highs, I won't be using that premium to buy more MicroStrategy. I'll probably be using it to buy more Tesla. And then the same will be true when everybody realizes that Tesla's going to be printing money with their robotaxi fleet, and they're going to be ramping up their $25,000 vehicle maybe in 2020. They probably won't have it even 2025, but it should be ramped up pretty well by 2027, I'm guessing. And so if Tesla's, still cheap and affordable in 2025 and MicroStrategy is expensive, I'll just peel off some MicroStrategy shares, load up on Tesla. Then if the bull market holds and MicroStrategy and Bitcoin crash some amount, Bitcoin's crashed 75%, probably a few times, and you just get numb to that eventually. The TradFi people don't understand how we can do that. But after you watch it happen once or twice and you're like, oh, this is just how it is, then you kind of get numb to it, and it takes a lot to ruffle your feathers. But yeah, so 2027, maybe MicroStrategy is cheap relative to Tesla. Maybe Tesla's ramping up and they've 10x'd by then, and we're looking at instead of 200 a share, we're looking at 2,000 a share. Then I'll be peeling off some Tesla shares to buy relatively cheap MicroStrategy. And then 2029, if MicroStrategy and Bitcoin have pumped again, I'll just keep flip-flopping. Now that's best case scenario, and I guess I'm just speaking it out into the universe to make that happen for me. But and it doesn't have to happen according to that timeline, but that is that's kind of like the rough theory that I have for how I'd like to trade these. And Dot Krueger had a really good Kelly Criterion video where he discussed what the optimal Bitcoin strategy was. And I know Michael Saylor famously says you never sell your Bitcoin, but Krueger did actually present a pretty, not necessarily convincing case, but a legit case for consideration that if you take like 50% of your cash, let's say when Bitcoin was worth 50 grand, you got 100 grand, you buy one Bitcoin and you keep half in cash. Now, I know cash is trash and it's constantly devaluing due to inflation, but short term, there are fluctuations that outweigh inflation. And so if Bitcoin goes up to 150K during this bull market, now your Bitcoin has tripled, so it's worth 150, and you got 50 in cash. So now your account is worth $200,000, and you would want to sell off some of that Bitcoin until you had a 50-50 ratio again. So what would you need? Like 2/3 of a Bitcoin at 150K? Yeah. And then if the bear market hits and Bitcoin crashes down to 75K or something from 150, now you're going to be cash heavy. And so then you would buy enough Bitcoin until you had a 50-50 ratio again. So I kind of don't imagine myself ever keeping cash. So what he presented is not appealing literally in relation to how I should handle my portfolio, a hypothetical portfolio of just Bitcoin and cash, but since I believe in Bitcoin and I believe in Tesla, that makes a little bit more sense to me. So if MicroStrategy pumps, I can sell some or be aggressive with my covered calls, use the premium to buy Tesla. If Tesla pumps, then I can just buy shares of MicroStrategy with the premium that I get from my Tesla covered calls. It's still a little bit one-sided because I'm so bullish on MicroStrategy over the next year and a half that it's completely dwarfing my 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 Tesla. I definitely do not have a 50-50 split. It's got to be like more like 80-20 or something. It might be like 80-10, and then I have 10 in miners as well. And I don't know. I may reduce my miner percentage here. I dumped my Mara because they started mining a fucking altcoin. May not be a scam coin because it's proof of work. I don't even think it had a pre-mine. So as far as shitcoins are concerned, it's probably one of the more decent projects. But Bitcoin's the only Bitcoin, and everything else is inferior to Bitcoin in every meaningful way. So um, mining something else is kind of unforgivable for me if you're a mining company. So I loaded up on like 20 puts of HUT, which I'll probably get assigned because HUT was pumped up to like $16 a share. So I went ahead and sold puts when it was way up, and I collected quite a bit of premium for that, but it may not make up for the drop in HUT if it retreats back to like $12 a share or something. But in that event, the down plan is the same as the up plan, and it really just doesn't matter. Just keep selling covered calls if I'm assigned the shares. But a lot of this mining company stuff that I have here is just to kind of fill in the gaps, make the algorithm a little bit happier, because they were not, Tasty Trade was not happy about how much MicroStrategy I had on margin. So I kind of figured I'd throw them a bone, and I guess the algorithm doesn't know that HUT, Riot, and MicroStrategy are all correlated to an extent to Bitcoin. So the algorithm wasn't pissed off at me since I was diversifying somewhat, even though really they're just all Bitcoin derivatives. And I really only have just this one Riot contract here because for some reason Tasty Trade doesn't give a margin discount on Riot. I have no idea what that's about. Robinhood is trading it just fine. And even on my 5K account, which I'm happy to say is now up to 6,900. It's probably been a few months. I think, yeah, a few months ago it was at 5K, maybe just a couple of months. I immediately turned it into like 3K. Then, because I was buying miners at all-time highs. But I'm also kind of doing a poor man's version of this. I dumped all my Mara and pretty much broke even, but somehow I'm up big time because I'm selling covered calls against all of this stuff. But even here, I was buying long calls in Tesla because they're so cheap and affordable. And let's see, my average cost on here was like $55 each. And on the pump, I went ahead and sold 2 at 146, so almost tripled my money on these. So kind of doing a smaller scale version of what I'm doing on the main account here. So I'm just selling a bunch of mining companies, buying more shares. I'm actually buying fractional shares of MicroStrategy here. since I can't afford to sell covered calls on MicroStrategy on a 5K account. So I'm using MicroStrategy as my store of value. And at one point, MicroStrategy had pumped up to, here, wherever the hell this was. And I went ahead and sold off like 3/4 of a MicroStrategy share and bought another 100 shares of Hut or Riot. I can't remember which one it was. So just doing this to prove that I remember how to trade a small account, and kind of to prove to people that say, oh, I have a small account, I have to trade credit spreads and debit spreads to make my buying power go farther. I don't think that that's the case. Within just a few months, this account is up like 40%, almost 35%. So um, it's not necessary to gamble high risk stuff just because you have a small account. You can still grind away making 1% returns a week. That's 50% a year. You're still going to eventually get rich using compound interest if you can just keep reinvesting the profits. Just keep plugging away at it. Eventually, the math wins. So that's about it for now. Tesla is the only car company in the world right now. Nobody else is a car company because nobody else does what Tesla does. And it kind of reminds me of selling options. I guess my circle is a little bit option seller heavy, but there's so many people out there that are still, they just FUD on option sellers. And one guy was like, "Oh yeah, selling options is okay as long as you have a risk management strategy." And I'm like, "What risk management strategy does a covered call option seller need that an index fund investor or a dividend investor not have to utilize? You still got to own the stock, and if the stock goes to zero, you're screwed. Except when I'm selling options against it, I'm collecting some premium all the way down to zero. So I'm still gonna go broke, but it's gonna be a hell of a lot slower than someone who just holds stock and does nothing. So I don't really know what their deal is when they talk about option sellers have, I guess long calls and and buying puts is super risky, and that just gives all of options a bad name. But I've been doing this since May of 2020. And other than when I had my head up my ass and I stopped selling covered calls and puts and I started selling poor men's covered calls into the bear market, that completely wrecked my account. But other than doing that dumb shit, selling covered calls and selling cash secured puts has pretty much printed money over the last 4 years. So as far as I'm concerned, it's the safest trading strategy in the stock market. And I'd really be interested to hear someone, if they have some kind of reasoning why I'm wrong about that. But selling covered calls and cash secured puts gives you a discount every time you buy the stock. So how could that be more risky? Like if you're buying stock and you're paying full price, and I'm buying shares of stock and I'm getting a discount every time, I really need somebody to explain to me how what I'm doing is risky and not the absolute safest play in the stock market. So get out there, get your phone out, download the Tesla app, test drive one. I actually just I test drove a Tesla using only my frickin' phone. Drove out to the mall parking lot where the thing was parked, unlocked it with my phone, drove the damn thing away. Well, actually, it drove the damn thing away. I'd never driven one before. Full self-driving was friggin' amazing. Uh, I already knew they weren't just a car company, but when I felt the car just drive itself and not rear end the cop in front of me at the stoplight, I was kind of terrified about that. But once I experienced full self-driving, I just knew Tesla was not just a freaking car company. They're a tech company that makes cars. And I could have said all of that with fewer words if I'd only had more time. All right, be good, y'all.